Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing LendingClub stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. LendingClub was a peer-to-peer lending company. It was the first peer-to-peer lender to register its offerings as securities with the SEC and also to offer loan trading on a secondary market. At its height, LendingClub was the world's largest peer-to-peer lending platform. Last year, the company acquired Radius Bank and announced that it would be shutting down its peer-to-peer lending platform. It now operates as a bank and uses the money people put into their savings and checking accounts to fund loans. If I wanted a loan, I can simply go to their website and apply for a loan up to $40,000. They also offer business loans that go up to $500,000. The interest rate I would pay would mainly be dependent on my credit risk, using my FICO score, my salary, and other info. The loan terms can be as high as 3 to 5 years. It was initially launched on Facebook as one of Facebook's first applications. It currently has 4 million customers and originated over $70 billion in loans. The company is headquartered in San Francisco, California, and was founded in 2006. The ticker trades on the New York Stock Exchange and Deutsche Borse. Let's get started with the model. This is a small cap company. 1.8 billion market cap. They're trading at $18 a share and they have 101 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had their first positive free cash flow in 2020 and it was a little lower in 2021. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's only positive in 2021. Revenue is a sales for the company, and that was the highest in 2021 at $819 million. This is the top half of the company's income statement. This gives us a breakdown of their revenue. Most of their revenue is from their online marketplace, $578 million. Here's a breakdown of their marketplace revenue, $417 million from origination fees. Those are all the fees during the loan origination process. Sometimes the company services the loans. When I say service, that means they receive the principal and interest payments from the borrower and then apply that to the loan. And if the borrower is delinquent, they have to go through the necessary measures to try to get the money. And sometimes they sell the loans to another bank. So they made $70 million from that. And $27 million of other income. So that's a total of $606 million of non-interest income. And they also receive interest income. Because the way banks make money, they'll pay you 0.5% to put money into a savings account. Then they take that money and lend it out to someone else at a 7 to 10% interest rate. The interest spread is how much money they make. The spread between how much they charge for a loan and how much they pay you to put your money into their savings account. They received $292 million of interest income. They paid $7.2 million to their customers for the interest on their cash deposits. They paid $58 million of interest on their notes. That same $58 million is up here on interest income. And then they have more interest payments on different borrowings. So their interest expense is $80 million, giving them a total revenue of $818 million. Last year was $318 million. And this is the bottom half of the income statement. They have to post provisions for credit losses. In case a lot of people default on their loans, they need to have extra cash available. They paid almost $300 million of salaries, $156 million of marketing, $39 million in equipment and software, $44 million in depreciation, and $47 million of professional services. So they did have positive net income for the first time, positive $19 million. Last year was negative $188 million. This shows us how much interest they earn on their investments. And they earn 9% if you average everything up. On the $710 million of cash, they only earn 26 basis points. If you went to their website and took a $5,000 loan, say to fix up your house, maybe pay down debt, whatever you want to do with it, the average interest rate they pay is almost 16%. That's called an unsecured loan. When you just take a consumer loan without posting an asset, that's unsecured. It's not secured by anything. That's why the interest rate is so high. If you have a secured consumer loan where you post your house or maybe your car as collateral, the interest rate goes down dramatically, 3.69%. Business loans are 5.5%. PPP loans are 4.78%. These are the loans the government gave out from COVID. 1/3 of their loans are unsecured. And you may think this is great because the interest rate is so high. But the reason the interest rate is so high is because a lot of people default. And if the Fed raises the interest rates, then their yield will go up. You can see each quarter their deposits and the loans they give out have been increasing from 2.2 billion up to 3 billion. And their interest rate spread has been going up a lot from 3.27% to 8.17%. The higher the spread, the more money this company makes. Most of the cash deposits they use to lend the money to others come from us if you have a savings account with Radius Bank or LendingClub. The interest rate they would pay you is about 0.3%, and the interest rate they charge is now up to 10.5%. It was under 5% in the first quarter of 2021. Some of their loans only charge a 3% interest rate. These may be loans to big companies that have really high credit quality. The total interest they earned in the fourth quarter of 2021 was 8.55%. And they paid 0.38% to the people who deposited money into a savings account. So the difference is the spread. So that's a really good sign that their spread is improving so much. The average FICO score is really high, 717. These are the FICO scores for the people that receive a loan through LendingClub. And the average income of the borrower is $114,000. Their debt to income is also really good at 19%. That's the total amount of debt they have over their income, their salary. The average coupon on a loan is 12.2%. The average time remaining on a loan is 16 months. They did beat their fourth quarter targets. They targeted for 2.8 billion to 3 billion of loan originations. They got 3.1 billion. They beat their revenue target and their net income target. They have $35 million of cash and 651 million of customer deposits. So the cash they have available is 687 million. This is the asset section of their balance sheet. They have 76 million restricted cash. They have 2.9 billion of loans on their balance sheet. So these are the loans they service. If they wanted to clean up their balance sheet, they could sell or securitize these loans and then get the cash for them. They have 230 million of certificate loans, 75 million of goodwill. Goodwill is the premium you pay when you acquire another company, and 300,000 of other. So they have 4.9 billion of assets. This is the best way to value a bank, is assets minus liabilities. Or you can look at their price to book ratio. And this is the right side of their balance sheet, the liabilities and equity. They have 4 billion of liabilities. Last year they were not a bank, so they couldn't carry these loans on their balance sheet because they didn't provide the loans. It was peer-to-peer lending. I would actually go to their website and provide the loan to someone else. In a way, I'm still providing the loans. Instead of lending money directly to the borrower, I'm putting it into a savings account or maybe a checking account, and then LendingClub is taking that money and loaning it out. So their interest rate spread is a lot higher now than before. Also, some people buy CDs through the bank. Say I bought a 2% 3-year CD for $50,000. That means each year I would receive 2% of my $50,000, then receive my entire $50,000 principal balance at the end of the 3-year term. They also use money from CDs to provide loans to others. And their equity balance is 850 million, so they raised 1.6 billion from selling their business, from selling common stock, and they lost 770 million from running their business. Accumulated deficit is a sum of all their prior net incomes. So net assets, or assets minus liabilities, which is 850 million. That's generally the best way to value a bank. Their equity balance has gone up, but you have to apply this to their market cap. Let's just say, for example, their market cap was identical at the end of 12/31/20 and 12/31/21. Then obviously they're a much better value at 12/31/21 since they have a higher equity balance. Let's say at the end of 2020 their market cap was 4 billion. At the end of 2021 their market cap was 2 billion. In that case, it was a much better investment at the end of 2020 than the end of 2021. Let's look at their capital structure. 850 million of equity, 338 million of debt. There's 72% equity, 28% debt. Their equity balance has declined a little bit over the years, and their debt has gone up quite a bit. In the beginning of 2021, their debt was a good amount higher than their equity, but now it's come down a little bit. Ideally, you'd like the debt to be lower than the equity. A company doesn't have to be debt-free, but it's safer to not be too leveraged like Ford and AT&T, because if interest rates go up a lot, that could be a big problem. And I gave them a WACC of 9.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year, for that $6.8 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $5.9 billion. We divide that by 101 million shares, and we get a calculated stock price of $58. They're trading at $18, so they're trading at a 69% discount. It's a really strong buy according to the model. The company's 2022 revenue guidance is $1.1 billion to $1.2 billion. I wasn't sure if they would do that in 2022, so I gave them that number in 2023. So I grew their revenue 18.5% per year to get to that number, and I grew it at the same rate the next 2 years. The average company in their industry converts 30% of their revenue into free cash flow, so I multiplied their future revenue estimates by 30%. That's how I got their future free cash flows. So I'm not sure if a discounted cash flow model is appropriate for a company like this, but I do this every video, so you can decide for yourself if you want to use a number or not. Like I said, tracking the price to book over time is probably the best indicator. 5 analysts priced this stock, and the average price target is $37. The low is $27, the high is $60. This is where the stock has been trading the last 2 years. For several months, the stock was really low, well below $5. But once they announced they were going to become a bank, then the stock price got driven up almost to $50. Generally, when a stock price gets driven up really quickly, people want to take in their profits and sell off, and it pushes the stock price down. But I think we're getting close to the bottom, because I think the stock does deserve to be closer to $50, not $18. And they have a beta of 2.09, so the stock is very volatile. It moves more than 2 times the market. It's gone up 48% in the past 52 weeks, while the S&P is up 14%. The 52-week low is 10, the high is 49. And the stock has been on a decline, trading below its 50-day and 200-day moving average. 3 to 3.5 million shares are traded each day. Of the 101 million shares outstanding, 99 million are on float, 77% are held by institutions, and 8% of the shares are shorted. This is their employee count through the end of 2020. It peaked at 1,700, but it's come down to 1,000. If you put $10,000 into this company when they IPO'd in 2014, you'd be at $1,500 today. But if you picked it up 2 years ago or 1.5 years ago at the bottom, you're probably up 10x already. Here's a chart of the insider buying and selling the past year. 6,000 shares have been sold. 3 out of 4 quarters, insiders have bought stock. Here's a list of the insiders that bought or sold, the date, the number of shares, and the price. 75% of the shares are held by institutions, 23% by the general public, and 2% by insiders. Vanguard is the biggest shareholder at 8.5%, then Jackson Square Partners, BlackRock, Fidelity, and Nikko Asset Management. The best way to look at ratios is to compare them to companies in the same industry. There are 49 companies in the same industry as LendingClub. LendingClub is the 26th largest in terms of market cap at $1.8 billion. The average is $15 billion. The most relevant number here is price to book, and that is much better than average. So that's a good sign. But remember, price to book is assets minus liabilities. So you want to look at their assets to make sure they're good assets. For instance, what if they lent the money to really risky people and most of them didn't pay? Then the company would lose a ton of money, right? But we did see the average FICO score is above 700. So that does imply the borrowers are fairly creditworthy. So to summarize, I have them trading at a 69% discount. And now that they're a bank, I think they're a really good investment because their interest margins are so much wider now because they get cheap money. The interest rate they pay to get cash is only 0.3%. A normal business would need to take a loan for 3, 4, 5, maybe even 10%. As long as they have appropriate lending standards and not too many of their loans default, it seems like the company is really undervalued. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.